Hello and welcome to Westpac London's videocast. It's Wednesday the 27th of July. Another quite choppy day in terms of equity markets again. European markets down, Euro stocks ending down 1.7%, FTSE ending down 1.2%. Same again in the US, continued weakness in equities. Dow Jones and S&P currently down for the fourth consecutive day in a row at the moment, and the longer these negotiations go on for the debt ceiling in the US and the closer we get to this August 2nd deadline, the more nervous the markets are getting that a deal will not be done in time. Now what does that actually mean? Well, in terms of reaching the deadline, whether they actually reach a deadline or not, it's probably still likely that they will. It's been done before in the past. There's a lot of political brinkmanship going on right now. And we've seen more often than not that a deal will get done, some kind of 11th hour deal. The problem that we're facing at the moment though is the ratings agencies have made it very clear they want to see a long-term fiscal plan to cut the US deficit at least $4 trillion worth of $4 trillion worth of cuts over the next few years. Now the question here is, will the US manage to get through this and still maintain their AAA rating? At the moment, it doesn't seem like that's actually going to happen. Given the time frame involved for them to get this deal signed off, and the ideological differences going on at the moment between the Republican Party and the Democrats, it's really not a lot of time there for them to get a grand plan of $4 trillion worth of cuts in place. At the best, we can probably hope for a short-term deal, possibly something around $2 trillion worth of cuts over the next couple of years, and potentially a raising of the debt ceiling which will allow them to get through the next 12 to 18 months, possibly until after the elections, where they can go through the whole thing again. So what does that actually mean for the bond markets? Well, if the US are downgraded to AA, it does have some serious ramifications. Treasuries are obviously used in every part of the financial sector: banking, regulatory capital, collateral, and if we see any forced selling, it's going to have quite wide ramifications. Now I don't think we're actually going to get to that stage at the moment. There are ways around this. We still think that the US will do everything they can not to actually default, but in terms of the downgrade, if it does happen, maybe it's a short-term downgrade. If not, well, we may see some of the money market funds coming out saying that they're still happy to use US Treasuries. Where else are banks going to take to put their capital at the moment? We are seeing some outperformance from bonds right now, but as I said, the markets are getting a little bit edgy at the moment, and we're seeing it in the price action today. Treasuries around 4 or 5 basis points higher across the curve, and that's in the face of a weakness in equities and weakness in US data. So as I said, the longer this goes on, the more downward pressure there's going to be on Treasuries going forward. Europe, to be fair, not really doing too much better. We're still seeing Italy and Spain underperforming, spreads widening out another sort of 20 basis points against bonds today in the 5-year and the 10-year sector of the curve. And that was actually brought about by some comments from the German finance minister earlier this morning, just insisting and expressing that Germany's disapproval, and insisting that they're not writing a blank check to bail out countries and purchase bonds for any other country that gets in trouble. And I think it highlights the fact that even though we had this deal from the EFSF last week, there's still a lot of implementation risk and a lot of political risk going forward. It's going to take quite a bit of time for all these new measures to be implemented and ratified by all the national parliaments. So the markets really still remain quite susceptible to political headlines going forward from here. In terms of the data front, we had the preliminary German CPI data out today, just edging higher to 2.6 annually from 2.4 previously. We don't actually get the breakdown because it was a preliminary result, so we're not quite sure of what the drivers were there, and obviously not a bit of a concern for the ECB. But when you actually look at the activity data, we have seen all the leading indicators turning slightly lower, and we think that's going to ease price pressures as we go forward over the next couple of months. So we don't see inflation going much higher in Germany going forward. In the US, we had durable goods orders slightly weaker again, down 2.1% on the month. Very volatile number. It does spike higher and lower quite regularly, but the trend has been fairly sideways over the last few months, so nothing to get too concerned about, but clearly not exactly a great positive, and pretty much in line with the other data that we were seeing out in the US, still coming in slightly on the weaker side. In terms of some numbers then, so as I mentioned, Euro Stoxx was down 1.7%, FTSE closed down 1.2%. At the moment, the Dow is down around 100 points, S&P 500 is down just over 1%, so not looking too great there at the moment. Currency markets though, Aussie obviously had a storming overnight session on the back of the higher than expected CPI print in Australia. We did see a high of 110.80 just at the open, and then just consolidating those gains during our session, currently trading just above 110 at the moment. Things to watch out for today, there's no data out in Australia, but just over the pond, RBNZ have their meeting today. We're not expecting any change in the cash rate, but there has been a significant improvement in the data, and some people have been talking about possibly expecting the RBNZ to bring forward their next rate hike, possibly as early as Q3, so just watch out for any hawkish statements from the governor tomorrow. That's it from me, and I'll see you again tomorrow. Thanks.